My name is John Vance, president and founder of Vance Wealth. Today is our mid-year market and economic update. I've been doing this now for over 15 years. Really enjoy being able to just share what's happening in the financial markets, as well as what's going on in the economy. It's really a good chance for me to just share kind of at a macro level what's happening, because I know a lot of times when we're meeting with clients, we really try to spend that time focusing on what's important to them, and that's their financial goals, how their investments are doing, really, catered to their unique situation. So again, this is just a great forum for me to share, give an update on what's happening. So hope everyone's doing well. Hope everyone's having an amazing summer. I can't believe we're almost here at the end of July. I just was, for many of you probably know, I was in Italy and Croatia with my two daughters for over 3 weeks. So it was an amazing trip. Great trip, but also happy to be back, and kids start school here in the next couple of weeks. So hope everyone's doing well, family's doing well. And I know most of you I'll be connecting with as we go into year end. Either you'll be connecting with me or your lead advisor here at Vance Wealth. And these topics we're going to cover today, again, are primarily market and economic driven. You are obviously welcome to reach out to us as a firm if you have more specific questions, and these also can be topics you discuss at your year-end meeting. Just a couple quick housekeeping items. This is being recorded, so if you have to jump off, this is something that we'll be able to send out to you as part of our follow-up. Additionally, you have a Q&A tab at the bottom of your screen. Go ahead and ask questions. Because this tends to get a little bit technical, I'm happy to answer them. If something gets a little bit too much in the weeds, then what I'll make sure we do is we'll write down that question, and then we'll follow up with you in a fairly timely manner to get back to you. So without further ado, why don't we get started? And we got kind of a bunch of stuff to go through. So let me make sure my slide is working here. Okay. So it was kind of an interesting thing that I went through. I've now been doing these for over 15 years, so I have a ton of content. As I was preparing for the conversation today, I went back through the last year's mid-year and looked at, well, what did I say? And then I also looked at the annual one that we hosted in January. So it was an interesting exercise to go through that, and how we're going to actually run this is a little bit of, what did I say a year ago? What did I say 6 months ago? And, what's happening today? Because I thought it was a helpful reflection to actually look back, because so much of our messaging around what's happening in the markets, what's happening in the economy, at the end of the day, there's good news that occurs, there's bad news that occurs. And, that's just normal. That's been happening for decades, for centuries, and it's really not going away. And there's always a lot of noise out there. And unfortunately, most of the time, we tend to focus on a lot of the negatives. But the beauty about being a long-term investors is that there's actually quite a lot of positive that we can get excited about, because we know generally over time, things like real estate, things like stocks tend to go higher, especially when we're looking at 5-year, 10-year, 15-year, 20-year time horizons. And so, one of the nice things, I do like to deliver the content in this market and economic update on what's going on, but the reality is these are things that are out of our control. These are the things that, a lot of times can get us overly emotional or sometimes overly greedy. But at the end of the day, kind of the tried and true way to invest and to be disciplined about decision making, kind of never changes, right? You have to employ a very disciplined approach to how you save, how you invest, how you withdraw your money. And that's obviously why many of you work with us, so we can help guide you through a lot of this noise. So as a reflection, looking back, I do think it's helpful to just look at some of the messaging that we've been able to convey to you. One of the hardest things in doing this is we don't have a crystal ball. I don't have information about the future that someone else doesn't have, or at the end of the day, we don't have that information, right? We don't know what the future is going to hold. So in going through a little bit of review, I think it's a helpful exercise just to kind of see, like, what have we been saying, and then we'll wrap up with, what now, right? We're in July of 2023. Are there things that are concerning to us? Are there things that we see as opportunities? And that's what we'll wrap up with. Okay, so 2022, what did we say 1 year ago? This was July of last year. So we talked a lot about how the Federal Reserve started raising rates. And at the end of the day, because we had cut rates and have been in a low interest rate environment for so long, the Fed with raising rates really kind of popped the asset bubble. And that was, we had a bubble in stocks, real estate, cryptocurrency, bonds, it was pretty much across the board. And the reason they had to do that is because there was a lot of inflationary pressures in the system due to things like rising oil prices, due to a lot of money in the system because of all the stimulus checks. And so they didn't state this, but essentially that's what happened. They said, okay, we need to kind of slow down. Asset prices were going up too far, too much, too fast, and we got to slow that down. Well, we now, with hindsight as a benefit to us, we can look and say, all right, well, did they accomplish the goal? And we know they did, because the markets were very weak in 2022. So these are some of the things we talked about. So remember, this presentation today is going to be broken up into 3 topics: where we were a year ago, 6 months, and then today. So we're focusing right now on a year ago. So at this point, we had seen one of the worst starts to the year for bonds, one of the top 3 worst starts for stocks. So a pretty dismal start to the year. We saw that happening in real time. Actually, this was the worst 3-year period that we'd ever seen in the bond market. And, we all look as investors, we know that bonds are designed to be safe investments, right? Safe. They're lower volatility, lower returns over time, but they're designed to be safe. And we just went through a 3-year period where we saw essentially negative returns. And that was the worst period that we had seen since 1926. So in nearly 100 years. Then we started seeing all these headlines like, well, what's causing this? Well, the Federal Reserve has been, basically raising rates, and it's the biggest move we've seen since 1994, right? That's the headline in the Wall Street Journal. And we say, oh, another one, right? Inflation was really the massive story over the last 12 months. We hadn't seen this level of inflation since 1981. And there's all kinds of things that were factored into that, like gasoline and airfare and energy and furniture and groceries and vehicles, right? All of these things that were compiling to this. And these are the headlines that we're getting bombarded with. And so what that did, all of that noise that we discussed, bad markets, bad economic data, it actually drove consumer sentiment to an extremely low level. And let me explain what this means. Well, the University of Michigan puts together basically a survey around consumer sentiment. Basically, the long and short of it is, are you optimistic or are you pessimistic? Really just trying to get a sense of how you feel. And what we do know is that the consumer sentiment is a very good contrarian indicator. When people feel really pessimistic, that is generally a great time to invest. And when people are overly optimistic, it's generally a bad time to invest. And the reason for it, now there's multiple reasons, but the simple reason is that when there's a high level of pessimism or skepticism, that means there's a lot of money on the sideline. People are putting money in cash, not investing it. So if things get a little bit better, what happens? That cash tends to get invested. So what does that mean? It drives prices up. Conversely, when people are really optimistic and think things are going to be great, what happens? There's not a lot of cash on the sidelines. Most of the money is fully deployed, which means those investments tend not to go up as much because the cash is already invested. There's not a lot of fuel to the investment fire, I guess we would say, to really drive prices higher. And so this chart goes back to 1971, so over 50 years. And there's a lot of ups and downs in here. I did circle the bottom right. So it showed us June of 2022, which basically was about a month. It was at the time that I gave the mid-year update, was showing that we were at a sentiment low that essentially had not been seen since May of 1980. So this was one of the worst sentiment factors on record going back over the last 50 years. So pessimism was through the roof. Now, if you look at the top left, if you can see this, and there's a lot of data on here, it basically measures that say throughout this chart here, we had 8 peaks in sentiment, which means sentiment was high, and we had 8 troughs in sentiment, which means sentiment was low. And basically, then they evaluated the S&P 500 return 12-month in the future. And basically, the times where there's peaks, which means high optimism, the average return on the market was 4%. But the troughs, when there was peak pessimism, the average return was around 25%. So that just illustrates the point. And so part of what we were looking at last year is, yeah, there's a lot of bad news, but when there's bad news, a lot of times that's priced into the markets. Now, so dealing with consumer sentiment, hopefully this makes sense. This is a terrible way to invest unless you're using this as a contrarian indicator. meaning when it's down low, that means I want to be a buyer, and when it gets too high, I want to be a seller. So that's how we view this. And the reality is, so this also takes a long-term approach to looking at the markets, and kind of this idea of, if you've heard the term, Wall Street climbs a wall of worry. So basically the whole idea is that the stock market always has these things to worry about. The economy always has these things to worry about. And the near term and the long term, the past, there is no exception to that. Sorry, I got something in my eye. So this just shows all of the headlines on why you shouldn't invest. And again, this is not going away. This has been the last 40 years. This is going to go on for the next 40 years. And part of the discipline is just to kind of accept it as part of investing and not be overly emotional about it. So this was how I wrapped up the mid-year update. And I really wanted to talk about, because we had gone through 6 months of a really tough market. And this was at the end of the day, what I called the three crucial lessons for weathering the stock market storm. Number one, a recession is not a reason to sell. Number two, time the market, meaning getting in and out of the market at your peril. Number three, it may be a good time to reassess your portfolio and plan. So at the end of the day, the reason why we make changes to any investments we make, at the core of it, is because we have a change in our financial goals. Something is happening in our financial life that would cause us to make a change. The markets are always going to have reasons to do this. A recession or an expansion will have reasons to do this, but that really shouldn't be the driver. It should be a change in your financial goals and objectives. That's why bottom number three was really important, because you know what? If there's a lot going on around you, we should assess, what does your portfolio look like and what does your plan look like? The data on the right basically just shows, how did the market perform after periods of decline? And at the mid-year last year, we had talked about the markets being down 20%, and it showed how did the markets historically do when we had corrections on a 1, 3, and 5 year basis. And you can see on a 20% market decline, the data, at least in the past, was really strong on a recovery. So that was just kind of the mantra, and a little bit of it is hey, just keep your plan as is. There's no reason to panic, no reason to adjust. Okay, so then we went through the end of the year. Markets held up okay. Things really didn't get too much worse, but they didn't really get much better either. So the second half of 2022 was not phenomenal, and that got us to our annual update that we did in January. So here's what we said. So we really looked at this dismal year, and this chart is very noisy, but what this chart basically shows goes back to 1976. And this scatter plot basically shows, in the top right corner is a good year for bonds and a good year for stocks. That happens 72% of the time. And then you have the bottom right corner, which basically is a bad year for stocks and bonds, which in this example had only happened once, which was last year. So obviously we reflect and look at last year, and it's okay, that was a really tough year. Then we get into all the headlines. Stocks, have the worst year, right? This is all the kind of the fear component of investing is, since 2008. Hold on, let's advance this. And then we had confirmed the worst year for bonds and the seventh worst year for stocks, right? A tough year. There's no way around that. And, I know a lot of times as advisors, just our industry in general, we measure losses in percentages, right? Okay, the bond market was down 13%. The stock market was down 18%. You as clients, investors, myself included, we make money in dollars, we lose money in dollars. While percentages are helpful to give us some perspective, that's not really the reality of how the results are for us. It's positive or negative on a dollar perspective. So last year, 2022 was a really tough year. The reality is, though, we know this happens. If you look back over the last 50 years, markets tend to be up 75% of the time and down 25% of the time when you measure them on a 1 year basis. So this type of volatility, while you can see here, this was for bonds was extraordinary. For stocks, fairly typical. Seventh worst year over the last 100 years, but this is not out of the equation, not out of the norm. And this is what should be expected as an investor. And then we started to go through, okay, well, the reality is markets had a bad year. What's going on in the economy, right? And so many of you really know that I did a workshop that was entitled "We're in a Recession and Why It's a Good Thing." Now, technically, if you see at the very bottom here, and I don't know if you can see my cursor, in the first quarter and second quarter of 22, we had negative growth in the economy. So technically, we entered in a recession, and then we came out of it. And so we just kind of had been forecasting some of the data from Raymond James as well, is that we were looking at a mild recession on the horizon. But one of the things that we identified was that this recession was going to look very different than we had seen in the past. I studied economics and finance in college, and so much of the economic conversation was around this idea of a business cycle, and that the business cycle, you have this expansion and contraction, and contraction meaning recession. And a lot of things that would happen during a business contraction is that kind of the whole economy, the whole business cycle would stop at the same time, right? There's a slowdown, which means you stop production. And when you stop production, you got to lay people off. And it has this ripple through the economy. And so that's what we're all used to from a recessionary perspective. Well, we felt like this one was going to be very different. And there were signs of that. And we weren't being ultra predictive, but it just kind of felt like, there are parts of the economy that are really thriving coming out of COVID. There are parts of the economy that we're doing great in COVID and are now slowing. And you can see some of these industries. And I think this resonated with everyone, is like, you look at the areas that were in a soft patch, good retailers, delivery, tech and streaming, housing, right? Those were all areas that boomed when COVID first started, but now we're going through a soft patch. And then when COVID hit, the airline industry, the restaurant industry, energy, healthcare, those industries just got clobbered, and they were coming out, they were now turning around, and they were in an upswing. And so this was back in January. We're seeing this trend continue. AI, artificial intelligence, has been the big buzz over the last 6 months. And guess what? Technology is back on the upswing. And so we really looked at the fact that, I think when we look back at this with the history books, we're going to look at this period of time as we were in a mild recession for 2 to 3 years. And it was this rolling recession. I don't know if it'll ever be defined that way, but when we look at the data, that's what it feels like to us, is that we're in this rolling recession. And the challenge becomes, is what's your perspective, right? If you're in the housing business or in the lending business, you're seeing a big slowdown, where if you're in the airline business or the restaurant business, you're seeing things boom, right? And so you have to be careful of the headlines, because there's a lot of fear, there's a lot of uncertainty, but we truly believe that this business cycle was going to be unique, and it's proving to be that way. Now, while I don't have a crystal ball, and we'll talk about this in the next section, we think there are some challenges ahead of us. So, but this is what we really talked about at the beginning of this year, is we're in a different kind of recessionary environment. And one of the things you all know from me is while I would define myself as cautiously optimistic, highly skeptical, I kind of trust but verify. I'm also like a go against the grain, a little bit of a that mentality. And if you notice here on this chart on the left-hand side, it basically showed the number of economists that were forecasting a recession. And the whole idea was, be careful following the herd. When everyone believes something should happen is kind of when things don't happen the way they should, right? And so when you have that much confidence, it's kind of funny just looking at historical trends, it tends to be where those things don't occur. And, while we look at this prediction, I do think there's actually a chance we're going to have an official mild recession. We'll see. We're heading into an election year. So I think calling an official recession might be something that the political party in power may not want to admit to. So we'll see if we actually get to a technical definition of a recession. But I think we probably, if we look at all the data, we can say we've been in this rolling recessionary environment for at least a year, probably more like 18 months, probably have another year ahead of us. But that's not catastrophic for the economy. It's not catastrophic for Americans. It's not catastrophic for the markets, even though there will be some bumps along the way. And now this is another report on the consumer confidence and the consumer sentiment. So if you look at this chart on the very far right-hand side, you can see the sentiment bumped up. So the low was in June of 2022 at that really low level that we hadn't seen in basically over 40 years. And now we saw a bump up, right? Because markets are doing a little bit better, job growth is improving, inflation's coming under control, so sentiment is improving. And you can see that sentiment went from a reading of 50 to now almost 60. And we'll come back to that. And Nick Murray, who's one of my favorite, basically I would call him a behavioral psychologist in our world, I think that this is a great quote that I shared. I don't worry about which way the next 20% move in the market will be, because I know exactly which way the next 100% move will be, and I can't run the risk of missing that move. And I think it's a good reminder, because I think too often, and I would say sometimes I can get caught up in this mindset of like, hey, we think bad things are on the horizon, so I'm going to make some decisions short term, trying to maybe miss some of the down 20% that might be coming, or that somehow I convince myself that's coming. But the reality is, when you're a long-term investor, just trying to avoid a little bit of the downside pain is really not the exercise, because if you're a long-term investor, 10 years plus, the reality is markets are likely going to be going in in a direction higher, and that's what you want to make sure you don't miss, because those are when you miss that next 100% up, it's really hard to recover from that. So it's about staying fully invested. Okay, so that was in looking at the last two mid-year and annual updates that we did. Now, I did summarize those just to kind of move through that with a little bit better pace, and we're doing good on time. So now I just want to give you a current update. Where are we today, right? So this is our mid-year market and economic update for 2023, and it's going to be trying to reflect on some of the things we just covered, but just really a reality check of like, where are things? So if you're not following the financial markets, and we look at this chart on the left-hand side, this data is a little bit old. It does come from the Wall Street Journal, but it's only about a week old. And it shows that the year-to-date performance of the three major indexes, the NASDAQ, which tends to be tech-heavy, the S&P 500, and the Dow. So the NASDAQ is up roughly 40% year-to-date. The S&P is up roughly 20% year-to-date. And I think the Dow is up, let's call it 6 or 7% year-to-date. So when you think about those indexes, as you have the NASDAQ, which is very technology heavy, the S&P, which is more broad-based, but still heavy on growth companies, and then the Dow, which tends to be more blue chip, more value. So you can see that type of performance. And, year to date, obviously, it's been driven by tech dominated. Now, if we look at the far right-hand side and look at last year, it was basically the opposite. So I tried to highlight this. Hopefully you can read this. The S&P last year was down 18. The Dow was down just shy of 7. And the NASDAQ was down 32. So it's basically a mirror of that. And so the reality is this is a significant example of like markets go through these up and down phases, and positive performance or negative performance just don't go in one direction. And one of the big important part of what we do and how to manage a portfolio is rebalancing, right? We have parts of the portfolio that are doing better. So the whole part of rebalancing is you trim take some profits from those that are performing really well, and you redeploy that capital into something that is not performing as well, which we would argue is out of favor and of better value. And so when we look at this data, this is actually a really helpful tool to see that, performance is going to be choppy from year to year, but it's just how do you manage that decisions that you make. The chart in the middle basically just shows what the estimates are on GDP, which is gross domestic product. That came out from the Atlanta Fed, looking at some positive growth. You do see kind of in the middle there, those two negative below the line. That was what I would call entering into a recession. And then we've had pretty modest growth from a gross domestic product perspective. So we're still forecasting a growth for this quarter. And I'll show you some charts on when we think we might get into an official slowdown. Now we're starting to see the headlines, right? So remember, at the beginning of the year, everyone's predicting a recession, and now here's the headline. This was just from, again, a couple of weeks ago. Economists dial back recession predictions. So now you're getting all these people who are like convinced we're going to have a recession, and now that's starting to come back. And again, that just kind of flows with this whole idea of optimism and pessimism. And now that markets are doing better, pricing is up. Now it's like, oh, maybe things aren't as bad. Again, this is kind of at some point of a gamesmanship that's played by the media, the financial press, and just kind of the back and forth with fear and greed. But we're dialing back recession predictions. This is some of the data that came out. This data came from multiple different sources, but basically we're looking at, the blue represents expected inflation. This is what was on the horizon for what we expected the inflation to be. Some of the forecasts that were coming out based on the markets and also based on the Fed, and then what's happened to inflation. So you can see the forecast just at the beginning of the year was that inflation was going to continue to go up. the reality is this whole year, inflation's been coming down, trending in the right way. And we see that trend continuing. So there's been a big disconnect. And I think that's one of the reasons why the markets have done better is inflation has come under control. So what the Fed is doing is working. And we can get into a longer debate at a later time on what they could have done to curb this in the first place. But it seems like what they're doing is working. Inflation expectations are coming down. That means we're getting close to the Federal Reserve being done. They did give us some guidance on they might raise rates 2 more times here in the near future, but that they're likely getting close to the end. So then we get into some predictions, like what do we think is going to happen? We still do think that according to the government standards, that a mild recession is still the baseline, right? We have an inverted yield curve. We have some challenges in the banking system. We have some challenges with commercial real estate. There are some things on the horizon. We have issues with Ukraine, right? There's still things on the horizon that are really looking at, forecasting a mild recession. Again, if we want to call it an official recession or not at this point, it's just semantics for us and for, I think, how you should look at it. Again, I actually like to embrace this approach that we've been in a mild recession for the last 18 months. We'll probably be in this for the next year. And that's just part of, the dynamics of our economy. We do seem to think that just looking at some of this data that, that interest rates, not necessarily over the next 6 months are going to lower, but when we get into next year in 2024, that interest rates will likely start making their way, trending down slightly. The bond market might move prior to the Fed. We'll see. But these are kind of the 5 reasons. This was actually a good slide put together by Raymond James, but you can see here the 5 reasons interest rates will move lower. Basically, you're starting to see that all this monetary tightening the Federal Reserve that the Federal Reserve did is actually starting to lead to lower growth. That the tightening cycle of rising rates is coming to an end. That inflation has peaked. We've already seen that data. There's clearly tighter lending conditions out there. It's harder to borrow money, and that acts as a drag on the economy. And then, we definitely see money that's flowing into the bond market because investors are really hungry for income. And when more money comes into the bond market, it tends to drive prices up and yields or interest rates down. Looks like we have a question. Let me just go double check on this real quick. Let me just read that and then see if we want to tackle this. So one of the questions that we got was that, isn't it true that inflation recently dropped because the administration took out volatile indexes like gas and food prices? Otherwise, it would still be at 8 to 9% inflation. So good question. So there's a couple different ways for me to answer that. And there's not really a perfect answer way for me to answer that, because essentially the government has the ability to kind of fudge the numbers. They can decide what inputs they put in. Specifically to your question, you have general CPI, which is a consumer price index. Then you have core CPI, which excludes food and energy. So depending on what headline you're reading, the traditional CPI measurement of inflation has been coming down faster than the core inflation rate has been coming down slower. I guess I was saying it the right way. It's been coming down slower than the true inflation rate because they exclude food and energy, and we know oil prices have come down, and that's driven some of the food pricing down. So the reality is, I do think there's some probably headlines that inflation would be higher. I don't think 8 and 9% is right. I think that the core CPI right now is trending in the 5% and below, and so that number to 8 to 9% is not. It doesn't seem to be accurate based on the economic data that I read. But I do think it's hard to know because the government will swap things out. So the government, when they measure inflation, they have the ability to change things out. When they're measuring food or energy, they can assume that consumers will shift their behavior and make changes. So, when they're putting in like the rent expense or a housing expense, they can decide, do I want to put in their home prices and home price affordability? Or do I want to put in what's called the owner's equivalent rent, which is a measure of rent? And they can decide. So they can adjust that number a little bit. So I think in general, this has been happening for the better part of 20 plus years. So I do think they try to manipulate that data to keep it a little bit more smooth. But what we're seeing in a lot of places, inflation rates are coming down. We still have to get the spending. It's still out of control. So that's got to come down to really hamper this. But I think the 8-9% number, I don't think is the reality. I do think we're more in the 4 and 5. And we do think inflation is going to run a little bit hotter than normal. We just went through 2 decades of inflation running around 2.5. We think the numbers are going to be closer to 3.5. Frankly, we think the politicians want that because if you have higher inflation, you got more tax revenue, more money to spend. And we also have a massive deficit of north of $30 trillion, and it's easier to pay off that debt with inflated dollars. And so we do think inflation is going to run a little bit hotter than we've seen in the last 20, probably more in line with like the 50-year average, which would put us closer to 3.5. So the other thing is, just kind of getting back on track, but that was a great question. When you look at like the sentiment that we had so much pessimism to start the year, right? And I alluded to that in the economic and market update that I did in January. But if you look at this list at the bottom, there was tons of reason to be pessimistic. Elevated inflation, the Fed tightening, recession concerns, earnings coming down, political risks, Russia-Ukraine conflict, supply chain issues, right? There was this list of all of these problems. And if you look on the chart on the left, it shows that sentiment was really low, meaning percentage of people that were bullish was really low. Now, I would argue maybe outside of the inflation, a lot of this hasn't really changed, but now look at the sentiment. It's a lot higher. You can see the spike on that chart on the left-hand side came up. And so, again, this just comes back to sentiment is not really a good indicator from an investment decision-making unless you use it as a contrarian, meaning doing opposite of what it indicates. Okay. I think I'm gonna, this chart, there's a lot on here, but basically, this kind of, this was basically wants to, there was the presentation that Raymond James put together had a really good, they were doing a big kind of play on the Tour de France, right? So they talked about Tour de France, and that was a lot of the themes of their presentation. I pulled out a couple slides so you can see here, a balanced portfolio has never won a leg. So that's a cycling reference. Basically what that means is a rebalanced or a balanced portfolio never finishes first or last. It usually finishes somewhere in the middle. So if you look at all the data that's in front of you, this is a 22-year chart and basically shows things like the S&P, the MSCI EFE, which measures international, the Bloomberg aggregate, which measures bonds, and then cash is cash. And then the light blue is the portfolio rebalanced annually. So basically what this shows you is, again, never finishes first or last, and it finds its way in the middle. And again, this is a healthy reminder about having discipline about looking at investing as this is a 20-year objective. Sometimes a 50-year objective is to really take that approach. And then when you look at, well, what are the results? Because isn't that what we care about? And the whole idea is like, a rebalanced portfolio that never wins a leg, but consistency has won the race in many cases. Now, this is data going back to basically kind of at the peak of the market back in 2000. But if you see here on the right-hand side, it has these fun badges, right? So the most victories, the S&P 500 has won the most victories on an annual basis, year to year, with the bond market being second place and then the international markets being third. But if you look at the cumulative winner, meaning where you started and where you ended, again, rebalancing the portfolio, needing to take money out to live off of, that the rebalanced portfolio won the gold. They were the cumulative winner. And that's just the reminder that from year to year, you're going to get some outperformance, some underperformance, but the discipline of making decisions through a 2 to 5 to 10-year cycle, that's really where that shows up. And again, any given year, you might be in, with a certain part of the index could be in first or last, but that balanced portfolio is usually going to find its way somewhere in the middle, which is just, again, an important reminder about being disciplined and diversified. Okay, now we're back to this consumer confidence, right? The sentiment that we talked about. And you can, if you can remember back a year ago, that sentiment was at 50. That's this blue dot at the very, very bottom here, which was abnormally low. We've now seen a rally from that time where the markets are now up 17% from that low. And now you look at where the green dot is, consumer sentiment is much higher, right? So a lot of the pessimism that was there is not there anymore. And so we're coming off of these lows. So again, this is a really, I wanted to show you this in real time because it really just shows you the impact of again, using this as a contrarian indicator. Lots here, but it's a really simple chart. Let's focus on the far right-hand side. Right now we're estimating, the federal funds rate is just over 5%. The Federal Reserve is now estimating that we're going to get closer to 5.6, which means 2 more rate increases of 0.25% or 25 basis points over the next few months. And then what we're looking at is the expectation going into 24, what the market's expecting and what the Federal Reserve is expecting is rates will come down by over 1%. And then you can see the long-term target. That's where the Fed wants to be. They want rates to come down to 2.5. And the reason why I'm showing you this is we're now at a time where rates are higher than they've been basically going back to 2000. So the last 20 years, we haven't seen rates quite this high, or I guess we're maybe on a even level with 2007. But the reality is the next move, once we go through this last little bump up, is going to be down. And that's going to have an impact on our investments, right? When interest rates go down, bonds tend to do well. They tend to go up in value. So in anticipating this, then we have to make some decisions on how we're going to allocate capital. So before I jump into that, I also want to just go through a reminder. When we diversify portfolios, we have US, we have international, we're always, no, I shouldn't say always, we are generally more heavily US focused, and that's by design. We live in the US, we spend US dollars. But we also recognize, and this data goes back to 1971, so it's over 50 years, that we go through periods of US outperformance, international outperformance. This chart shows you the magnitude, the time that they outperform, and then the magnitude. And then the gray represents US and the purple represents international. And so, some of the big periods of outperformance was in the 80s. International outperformed US by over 300%. The cycle we just went through the last 14 years, US outperformed by over 275%. And then we believe we're going to be in an international cycle where we start seeing some international outperformance. Now, this is only 1.6 years and it's only an outperformance of 1%. But it's got to start somewhere, and we think this trend is going to continue for a period of time, just based on valuations, based on US dollar strength, things like that. So that's just a high level. Again, we have discipline around investing. This is not causing us to allocate more money to international. It's just to maintain our discipline and conviction on how we manage the assets. One of the things that's a reminder, I think we're oftentimes bombarded so much about all the negativity that's out there. I think a lot of it as US focused investors, US citizens, we tend to have this mentality of we have a lot of problems in our country that we don't seem to be willing to solve. And again, I don't want to get into political conversation, but I know that's a lot of the feeling is like, is the next generation going to be as good as their parents' generation? And I think there's concerns about, okay, well, what does this mean for the US economy? And, when we look at it from an investing perspective, when you invest in US stocks, international stocks, you're investing in companies that sell products all over the world. The reality is we have some massive demographic changes that are going to bring a giant middle class to the consumption table, meaning people who were not consuming products. And the good news is US makes some of the best products in the world. And so we're going to be, our companies are going to be the benefactors of this. But if you look at the data on the left-hand side, it shows the growth of the middle class. Now, every country defines the middle class differently, but it shows you, in 1995 is the first data point, that 1% of India was in the middle class. They're estimating that now that's about 38%, and they're estimating by 2030, so 7 years from now, it'll be 79%. And then you can see what's happening in Indonesia, China, Brazil, Mexico. So there's clearly a trend to have more wealth that's accumulating, which provides more spending power. And if you look at the right-hand side, it shows the regional contribution of middle-class growth across the different continents. And if you look, I circled there North America. Not a lot of people in North America. Mexico is probably the biggest driver. If you stripped out Mexico, I think between Canada and US, that number would maybe be negative. You can see where Europe is. And so a lot of this middle-class growth is going to be coming in the Asia-Pacific region. And so while there's definitely headwinds for our economy, there's definitely challenges. At the end of the day, we are in a global society where we're going to have a massive amount of new consumers in basically in the world that are going to come online that have been out of the consumption patterns, I guess, for the world. And so this is going to be this is going to be very positive for a lot of companies because of the amount of people. I mean, this is looking at, when I read this data, that means we're looking at over 1 billion people over the next 7 years that are going to be entering into their version of the middle class, which will be a big positive. So when you look at some of these big trends, we got challenges. Hopefully we can tackle these challenges, but there's some of these demographic shifts that are going to be hard to ignore and will be net positives when you look at it from a long-term investment thematic perspective. This is just a reminder here when you look at some of these long-term trends, and sometimes we can get caught up in the weeds. And so this chart basically says, okay, well, let me look at how inflation has done, what's happened with cash, what's happened with bonds, and what's happened with stocks. And you can look at the disclosures at the bottom to see how we measure stocks, bonds, and cash. But basically we look at, okay, well, how did these different vehicles do in the 70s and the 80s and the 90s and the 2000s and the 2010s, and then year to date in this decade, I should say. And you look at the fact that inflation is up 700%, cash is up 900%. So on a inflation adjusted, cash is not up that much. And then you can see bonds, and then look in the very bottom right, stocks. It's up 20,000%. So it shows you the power over a long period of time of compounding, shows you the power of stocks against inflation. Because that's the questions we're getting a lot of, is I'm worried about inflation. Stocks and real estate traditionally are really good assets for that. Again, good assets for growth, good assets for inflation protection, especially when you look at it over a longer period of time. So it's just a helpful reminder of the power of being a long-term investor. And then I hope this is not too noisy, but we've been having a lot of questions or conversations with clients about what to do with cash. If I have cash, should I invest it in the markets? Should I leave it short term? And what this chart is designed to show you is just basically I want to show you what's happening in the U.S. Treasury market, which is the U.S. government bond market. And so on the different accesses, you can see we have on the bottom, we have this where it says 1M, that's 1 month Treasury, 2 month Treasury, 3 month, 4 month, 6 months, 1 year, 2 year, all the way to 30 year. So that's the duration of the bonds. And then on the left-hand side, you can see the percentages from 1% all the way up to 6% on the side. So if we look at the colors, well, what does this mean? So a year ago, when I did the mid-year update, it was the blue line. So you can see, at that time, if you wanted to buy a 3-month Treasury, you were getting paid just under 2%. And you can see that on the chart. Well, so that's right here. Then we looked at this kind of green color, and you can see the beginning of the year, this is what this yield curve looked like. And on a 3-month, you could earn about 4.5%. The red represents as of yesterday. So you can see all, like right now on the short-term basis, you can earn north of 5%, almost 5.5%, all the way out to 1 year. But then you look at, this is what's called an inverted yield curve. You can see now, but when you go out to 5 years, 7 years, 10 years, you're getting paid less. So a lot of clients that we've been having this conversation, well, if I can get paid more in the short term, why would I go out into the longer term? It's a very fair question, and there's not like a right or wrong answer, but the logic behind why you would go a little bit longer term is that the Federal Reserve is projecting, and the market is as well, that rates are going to peak here in this next 6-month period and start to come back down. So the benefit of going out a little bit longer is that if you buy a 5-year, 7-year, 10-year longer bond, you're buying it and kind of locking in that interest rate because you're going out in what's called duration. You're buying longer term bonds, so you're locking that in. So if the Federal Reserve lowers rate and you're locked in, that will protect some of your gains and provide potentially some appreciation because that's just how bonds work. But if you stay short term, what could happen is you could invest this in a 1 year, and a year from now, you go to reinvest the money and rates could be down at 3% or 2%. So that's the risk that you run. So when you're making those decisions, we are in 100% agreement that, short-term money that should be spent in the next, 1 to 2 years should be in more cash-like investments, short-term bonds. But as you start going out and saying, well, this is really 5-year money, this is really 10-year money, we want to be very particular about how we invest because we don't want to be short-sighted and say, hey, this looks better today, and ignore some of the economic facts that could occur in a declining rate environment. And so we want to be more thoughtful about that and not just discount and say, well, I'm just going to buy this because it's easy and I'm getting paid more, versus being a little bit more thoughtful and a little bit more looking into the future. Now, with that being said, we've been having plenty of dialogue about just parking some money in some of these short-term vehicles, just to kind of in a wait and see environment. And that's totally fine, but we want to have a game plan always. We don't want to just always do what feels easy. We want to do what should be right. That's what we're here to help with. So if you have any questions about this, especially when it comes to cash management, we're definitely here as a firm to help answer those questions and figure out the best place to put some cash. So one question, are you taking into account price appreciation for those longer term bonds if rates do fall? So good question. So, not to get too much into the weeds around how the whole bond market works, but essentially what happens is that if you buy a longer term bond, so something that's going to mature in 10 years, and you lock in the rate. So in this example, on a treasury, you would be locking in about a 4% yield, right? That's what it's paying. If interest rates decline from, let's say, 4% to 3%, and you own this 4% bond, it's going to be worth more money because investors are going to be willing to pay more for your bond that's paying 4%. So in essence, what happens is the value of your bond goes up. So when you look at long-term returns in bonds, there's a component of income or yield, and then there's a component of capital appreciation when values go up, and sometimes depreciation when bond values go down. So yeah, when you're taking into account looking at this longer term approach, there's a component of not only income but potential appreciation in a declining rate environment. Okay, so again, this is just reiterating a little bit more. So this is just proving some of the data. So if we actually look back historically at some of the data in the bond market, so we're just going to kind of highlight 3 areas here, and this is our last slide. 3 reasons to look beyond cash, right? We like cash for cash purposes. It's really fun right now because we're getting paid, north of 4%, in many cases 5%. That hasn't happened in 15 years. But the reality is we want to make sure we're being mindful of, well, is this the best place to park money? So if you look at the first item here, shorter term interest rates are higher than longer term. We just showed you that on the chart. But the reality is the average 12 months after the yield curve inverts, which means shorter term rates are higher than longer term, that short-term bonds and US core bonds tend to do better than money market rates. We focus on the middle here. Cash underperforms following a Fed pause. So it looks to us like the Federal Reserve is likely going to be pausing sometime here in the next 2 cycles. And so we're probably 3 months out from a pause. And historically, when we go back and look at different rate cycles, this period in time specifically is about 30 years. It shows that, well, how did these investments do 12 months following a pause? That it shows you cash, it shows you short-term bonds and core bonds. And so you can see performance is better in these bond positions, at least historically. And we know past performance is not always indicative of future results, but this does drive the core of how you make some decisions, is you want to see, well, how have things done in the past? And so do we use that as a little bit of a guiding light to shape some of our decisions? And the short answer is yes, we want to use this data. And then the third column on the far right is, well, how did core bond performance, how did it do when the federal funds rate was greater than inflation? And so right now, Fed funds rate is north of 5, inflation is running closer to 4, and then it shows you performance, on the core bonds when the Fed funds is greater than inflation is historically a higher return. So this is just a reminder. Again, there's many reasons we've been deploying cash into treasuries, into shorter term vehicles. We still think that's prudent, but we're now getting to a point because the Fed's likely going to pause. So we have to reassess, well, what is this money really for? Is it for safety? Is it for long-term investment? And start making some decisions around that and not just park it in cash because it's easy. And that's really what I think we're going to be tasked with our clients and how we're managing assets for the next 6 to 12 months, because I think it's a really important question. Hopefully this made sense. We are wrapping up. So that was the mid-year update. I truly hope you enjoyed a little bit of that perspective, just going back over last year, shedding some lights on things, light on the things that we discussed. As we go into year end, this is going to be an interesting year because if you live in the state of California, all of our tax deadlines were pushed back basically till October 15th on your individual tax returns. By now, most people, in July, August, have all their personal stuff done. So I know a lot of people are pushing this back to year end. We would encourage you get your taxes done if you can. If you owe taxes, you still have time to pay the tax liability, but get your tax returns done, because in order to do effective planning for this year, we're going to need to have your 2022 taxes in hand so we can actually effectively evaluate it. If we have any prospective clients on the call and need any help with anything we discussed today, you can schedule a 30-minute consultation with one of our advisors here just to see if we can help and make an impact on your life. And then the last piece on here is that we will be doing a year-end tax planning webinar on Tuesday, September 19th. So it looks like we're skipping an August one and we're going right into September 19th. So please make note of that. We will not be having an August webinar. I think that's right. So we're going to focus on our year-end tax planning in September. So as always, we're here to help, and hopefully this has been valuable. I'm John Vance, president and founder of Vance Wealth, and thank you so much for your time.